Welcome to the Commercial Real Estate Podcast powered by First National. I am Adam Pawadic, sitting here with Aaron Cameron at the Toronto Real Estate Forum Day 1. This is part of our speaker video series. Our sponsors for that are Dow, Vukovic, and CGI. We thank them for it. As many as you know, I started my career out at Colliers, and at the time I was brand new to the business. I managed to pull off a 6,000 square foot lease, 3-year term. Rents were probably $250 at the time. They were, this is a C-class product that was out there, trying to get my first deal done. And I managed to do it. And that's when you kind of realize that, yeah, you don't make a lot of money doing leases like that. And I'm a tiny little fish in a very big pond. Big fish at the time would have been our guest today, Gord Cook. He is vice chair at Colliers. Welcome, Gord. I'm sure that the last 14 years, nothing's changed and you're still top of the heap in the world of industrial real estate.
It's been a while. It's been a while, but an enjoyable run, that's for sure.
Well, especially too, because back then in industrial, I mean, as I was alluding to, my first deal was a sublease, so even lower rents, but you might be getting $4 a square foot in a decent lease then, and that's 5x'd over that time frame. Valuations have gone through the roof. Cap rates have come down. Not the worst time to kind of power through the industrial marketplace.
It came alive in probably 2016. Double-digit rent growth right through to COVID. Then we saw 2 years of 30% year-over-year rent growth. Rents are coming off now. We've probably seen 4 consecutive quarters of rent reduction. But shockingly, that rent reduction is probably only about 15% after all of those years of compounded growth. So stability is still there, showing some resilience. But all in all, I suspect the industrial market will weaken further into 2025. We're not through this.
Have you always been in industrial, Gord?
Well, yes, but my background started in landlord rep and tenant rep. I still do a lot of large kind of projects on behalf of, clients like Canadian Tire and others. But about 15 years ago, an associate at Colliers, Victor Kotick, and I have specialized in industrial investment. So it allows me to have a lens not only on what's happening on the rent side and understanding what occupiers and landlords are dealing with at the street level, but also that capital markets expertise on industrial investment. So we trade probably about $600 to $700 million a year of industrial investment real estate.
Nationwide.
Nationwide. I'd say 75% of that is right here in the GTA.
Right. It probably doesn't matter now, but I think it's an interesting question. And so, back in 2016, when I was a younger analyst, and an industrial deal would come across my desk, and even I would look at it and go, why are rents $5.50 a foot in industrial? And I think, what happened? What was the catalyst that basically caused that whole suppression of rents to course correct?
Well, great question. And what we really have to do is go back to 2009 and look what really happened, of what happened in Canada, specifically in the real estate development business because of the financial crisis. So right around 2010, we generally lost all merchant industrial developers, which really only left us our Canadian pension plans to be those capital sources for new supply, and a couple of privates like in Orlando and others. But we had very few privates left. So really, from that financial crisis, we undersupplied the market for 8 years. Undersupplied the market. So these were years where our absorption was net positive to the amount of new supply we're putting in the market. That took a 6% availability rate to 3%. That's what happened in 2016. Undersupplying the market for a decade, vacancy now at 3%. And then that quantitative easing really started then. You look at the cost of funds back in 2016, we saw some pretty good economic prosperity. We had the inlights of e-commerce. We had more consumer spending. We had a lot of good retail stories, some failures, some positive. But all in all, that really, really boosted demand for industrial space. And then really, COVID showed up and everything was just...
Everything was on fire at that
Everything
point.
was on fire. Yeah, we had shortage of supply because of entitlement delays, material delays. So we saw 12 million feet of absorption. Now we're having that hangover.
Anyone, some words got added to our lexicon, fulfillment centers, last mile delivery. There are a bunch of different things that kind of arose in our community as a result of sort of the growth of the industrial sector. Now, you described the industrial market today with some softening. Maybe just describe what you're seeing right now, and then we'll kind of dive into the future of industrial.
Well, listen, they probably out of all the decades I've been in the business, this is probably one of the real observations on the impacts of interest rates that we started to go up, what, February 2022, approximately. Commercial markets always lag. So even though interest rates were starting to hurt the consumer, they still had savings. So they kept spending. Corporations were still spending and adding stock to their building portfolios. 3PL logistics providers were still dealing with some of the onshoring issues with their customers. So even though we had the interest rate increases, we still saw rental growth. It really wasn't until 2023 where rents peaked and started to fall. While that was going on, we were still adding, in my mind, too much supply to the market. We're talking 13, 14 million feet a year. In 2023, net absorption was 3 million feet. So right there alone, we just bumped our availability rate 1.5 points. This year, we're going to be, again, 14 million feet. We're predicting net absorption to be about 3.5 million. Because in 2024, now we're really feeling a lagging economy. Corporate spending's down. Consumers are not here spending domestic goods for hard good retailers. So we have really a two-pronged effect where we don't have corporate growth, we don't have consumer spending, and we have too much supply coming on. I wish 2024 was kind of the end of this, but 2025, we are tracking another 13 to 14 million feet of new supply.
That's spec build.
That's spec
Doesn't make
build.
understand.
That's the real problem there, is there's going to be some people left holding the bag that can't lease out their
Why are
spaces.
they doing that?
That's the way it's done. That's the way it is.
You know, they may have a good land bases. Maybe they already have their capital.
You bear in mind, though, the trap you would have fallen into prior is, you start construction in 2018 on your industrial build, and you lock in your rents then because you're going to do it on a pre-leased basis. And now you get to the conclusion of your building, and rents have gone up $5 per square foot. That's not a great come either. So, of course, industrial builders are going to be inclined to want to wait to the last minute to lease up because that's been the best outcome for them for the last number of years.
Well, yeah, listen, my prediction, and this is something Victor and I put together in a presentation just last Thursday to a group of investors. I forecast that our availability rate will hit at least 5.8%, which we have not hit since 2012, by the end of next year. And that's really just because
Nationwide.
that's here in the GTA. Here in the GTA. And really that's just, again, muted demand, net new absorption relative to this inventory of another 14 million feet.
Maybe 20% tariffs or the made in Canada narrative will fix that.
You're 100% correct. You start comparing the GTA or national averages in Canada, our markets really still seem very constrained. There's a resiliency. And because of that, I really don't expect, too big of a fall off on rent. We've seen probably about a 15% discount. We're seeing more free rent. We're seeing more TIs. But at the end of the day, the market is holding quite strong. Where my nervousness is, for that user that takes that flight to quality, just rented a brand new 500,000 footer that he cut a great deal at, better than what he would have done 18 months ago, he's likely leaving behind 300,000 or 400,000 feet of second generation space. It's not like we have like a new target coming to the market, right? So often the deals that you see, they sound great, but there's space being left in the market from what they're moving out of. So those are usually that second generation space that might have some functional obsolescence, shorter shipping aprons, lower clear heights. I expect there'll be some bifurcation of rent between that stock of space and the new supply. It's a great time to take that flight to quality.
So what is that guy leaving? The vacancy that he's left is what, like $6.50 a square foot?
Most of that's been flushed through the system.
Okay.
Quite honestly, if somebody signed a 5-year lease, they're likely in that $12 range.
Right.
Right.
And now they're moving to 18 to 20.
There was a day of 20. I would say now we're seeing deals done between 17 and 19, depending on submarket and size.
Okay, that stuff that was 12, like what is that today? And that's, I guess, the bifurcation that you're talking about.
Listen, I think that's where we're going to see some bottoming. How low it goes, we're already seeing a lot of landlords proactively resetting price and trying to get ahead of this. Because, another stat that's quite fascinating, we are adding about 1 million feet a month into the GTA industrial market. It's, you start talking percentages, people get lost. It's not so difficult to lose 1 million feet of additional space being added per month.
And so there isn't a million square feet of absorption coming online. Is that your math?
That's why net absorption is so critical, because it takes into consideration the new supply as well as what's being leased, as well as the second generation space.
Industrial is largely a suburban asset class, and as the market's shifted and there's been winners and losers, emerging in these recent trends and changes, which municipalities have done well and which ones are falling behind, because it cannot be an even distribution.
100%. The story back, in even pre-COVID was, labor was so constrained, hyper rental rate growth. So markets like Hamilton became like the sought after market. Oh, we're the second largest employment market beside Toronto, right? So, stories like Hamilton, secondary markets like the KW region, even as far out as London, there was this strategy of, I can produce a better rent to my customer in some of these secondary markets. That, in my opinion, is completely slipped away because, construction costs are the same. Land values are coming down in core markets. Rental rates are coming down in core markets, and there's an availability of supply. Most occupiers do not want to move more than 25 kilometers from where they currently are. And more importantly, they don't want to move municipalities or regions, because that can fall into some issues around constructive dismissal and just supply chain logistics. So when you have a mature market, they will continue to perform better, right? And a new market like Caledon and Bolton, they're really just a bolt-on of Brampton. Same labor market, same intermodals. Markets that we're seeing weakness, Milton, the QEW corridor, too much supply, and it's a bit of a micro market, doesn't pull from other municipalities. Durham region, 7 million feet of new supply in a market that is only 70 million feet. So those are the areas that we got to watch.
I'm surprised to hear Milton, though, because I assumed that be a market with so much new product in it would have higher demand. Why is that not the case?
Good product being built in Milton, not as strong of a labor market. And even though on the map it looks like it's just beside Mississauga, completely different transit system, completely different labor market. When jobs are available, someone who lives in Mississauga or Brampton is not going to Milton to get the same hourly rate. They would go there when they couldn't get a job in Mississauga or Brampton, but job availability is here.
For those tenants that have been facing these astronomical rent increases over the last couple of years, can they leave the GTA or greater Golden Horseshoe area to solve that problem? Or is the labor issue you mentioned too much of an issue to try and escape?
Very difficult. There has been some case studies, and I think they're good case studies of some organizations that left the high cost markets. One would be a large tire distribution and manufacturing company that went to Cornwall, Ontario, 1 million foot building that they are just moving into right now. Great example of a secondary market. There was also one of the large global retailers that put a stake down for about 600,000 feet in London. Like the labor market, because of all the colleges and universities, retailers tend to flex up and down because of seasonality. So they saw London as an opportunity to own low land cost, good labor market. So we are seeing them, but generally speaking, yes, they're isolated case studies. Yeah.
How's the rest of the country doing?
Listen, I think there's a nice bright day in Alberta, particularly Calgary, but Edmonton as well. Even with the change in governments in the U.S., I think there's a pretty good story on oil and gas. But I also just like the domestic immigration that Calgary's seeing in particular. So that always bodes well on distribution and warehouse. They also have an inland intermodal, CP's intermodal, CN's intermodal. So a lot of freight leaves Vancouver ports or other Western ports, comes into Calgary, and then gets loaded into Toronto by rail. So I like that hub. It's proven, and going into the Calgary market or Edmonton market, we're talking $8.50 rents. That's a long way away from $18 rents we just talked about in Toronto, right?
What about Vancouver?
Yeah, they're gone, but they'll come back. The Vancouver story remains still a tight market, right? It never gets oversupplied.
It's just a land constraint thing, like it is with
100%.
all real estate in Vancouver, right?
Yeah, they talk about the GTA land constraint. Yeah, it's sure we have the moraine, but we still have a lot of flat land, and we have a lot of land that's designated for business employment. The Vancouver story is truly a constrained story, between entitlement issues, cost issues, and capital flow, right? A lot of capital just can't get scale in Vancouver, and it's just a hard market to break.
Where are rents there?
Rents are still north of $20. Yeah.
Wow.
Yeah,
But not to justify multi-story industrial, I guess. That's the issue.
almost not enough to support their very expensive land bases.
Well, and is there a level where we are concerned about the occupiers' ability to pay? I mean, lenders are notoriously pessimistic. We look at deals where they're pushing $18-19 per square foot, and we really were concerned. Like, can the occupiers actually afford that?
I think we all predicted there was going to be more pushback and more business failures because of this rent issue, going from 6 to 18. But shockingly enough, and I think a lot of it is because, rent typically only gross rent represents less than 5% of somebody's business operating cost, right? Labor's a bigger component. Transportation's a bigger component. Inventory of goods. So it's a small piece of the puzzle. So it handled that growth. But organizations have utilized automation and other technologies to make themselves more efficient to offset that higher rent. So where I've actually seen failure, it's actually maybe sometimes the manufacturing sector that are in a rental property that they can consolidate and make themselves more efficient by consolidating into another Canadian plant or consolidating back to a U.S. plant because maybe there's surplus capacity within their existing manufacturing environment. So we have seen some negative stories there. And then the other is sometimes that small business where they weren't really making a ton of money in the first place. COVID probably hit them hard if they were in the service or other business areas. And now they're just, labor's more expensive, rent's more expensive, and they've decided just to shutter their doors. The positive side is that there's been other industry types that have been backfilling that small bay product. So even though there's some pressure on small bay, it's been pretty resilient.
I don't want to sound harsh, but maybe it's Darwinism at play. Maybe that's tenants that were on the verge of collapse anyway. So that's why you see them, fall off the radar. Again, I don't want to be harsh.
Another good question. They do not care as much as our institutional capital cares, right? So we are building the right product for the future. Most new industrial buildings today are what I would call carbon neutral ready. So they're taking major infrastructure issues like building envelope, roof type, insulation levels, size of electrical rooms, the right roof structure to hold solar array in the future. So they're readying the property, which would have been hard to retrofit later. They're not always investing in the solar or in geothermal and these more expensive items to reduce their use of gas as a major source for heat in particular. So we're going in the right direction. On the occupier side, it is a short list where you'll actually find that as a priority with their warehouse, because often their warehouse is through a third-party logistics provider, right? So it's something we need to watch. You got to remember, the ownership group are really being forced in this direction because the lenders and the institutional owners are requesting it. So the industry is evolving this way. It's different than, say, a decade where everybody talked about LEED. Some people bought in, some people didn't. This carbon zero strategy is here and it's staying.
I was at a real estate forum 10 years ago. I can't remember where, somewhere in the Prairies region. And that question came up in one of the panels is, do tenants care about any of this? And honestly, the panel could not stop laughing at the mere concept. So I guess here we are 10 years later, and there's been some more penetration into the psyche of tenants that they do care about it, but likely still then only the kind of big brand names that we all know.
We are going in the right direction, 100%.
Yeah, well, they're not going to care until the employee cares, right? Like, it won't matter whether you're an employee at an industrial complex, or you're going to buy something at a mall, or you're renting an apartment building. I mean, collectively, we're not yet in a part in our society where we're willing to change our behaviors, change our decision making, because of our moral obligation to participate in a green event. Like, we're all still trying to survive life, and it's just not part of our decision making.
Well, definitely, if that green event is actually going to cost you more,
right?
And
it doesn't yet.
That's the trouble, is that, it's a great talking point, but is that tenant willing to pay more rent to have that benefit? And that benefit has to have a payback. Is my utility bills less? That's really the only driver for industrial.
And that's what I mean. Yeah, no, and it's not going to change until we really start demanding it, right? I'm not going to work for that employee unless, I'm not going to go and shop at that store unless, I'm not going to go and rent that apartment unless. And I think collectively, we're still not there yet. No, can we go to technology first? Then we'll go to lending. I think there's a lot of really interesting things happening in your space. I don't know. I want to say dark buildings, but I think it's the changes that are going on, as you've described, where there's a lot of pressure on yield, and a lot of pressure on expenses for these occupiers, and so they're looking for ways to change the way that they're operating inside that building. Inside the dark buildings, I'm describing, where lights are off, there's no humans involved, and it's just a whole bunch of robots moving around on zip lines, picking it out of parcels and delivering parcels into the back of trucks, and the trucks are driving away.
Freezer is a great example of automation, because it's actually the hardest sector to bring employees into the business. It's not a comfortable workplace. Bundled up, it's -4, up and down a forklift. So that sector does see automation, and it's a great use of automation because it's a tough area to actually have labor. So the problem we're in right now is cost of funds, right? Making new investments today are very, very difficult. And they usually have a very long horizon of payback. Organizations today are looking for a much quicker return on capital. And at the cost of capital today, the numbers really are not working. So we're not seeing a lot of new automation being invested today. The other reason why automation is popular is when the labor market is so tight, there's an issue around serviceability. So automation can help fill that gap when you just don't have enough employees. Well, we don't have that problem either right now, right? So cost of funds, access to labor is really pushing the automation story down the road a bit.
I mean, I hate that. I feel like Aaron and I have been talking about technology and real estate for a decade, and nothing's really happened.
I love this last mile discussion. And, to respond to the comment, like, drones are actually utilized today between warehouses, not so much to the consumer for that last touch. But what I find interesting, and I'm part of a supply chain group at Colliers, which is a North American team, and we have conferences 2 times a year. What I learned from that is the last mile, it really isn't the last mile. Last mile to downtown Toronto could be Brampton, right? You're on highways, you can be to your consumer inside of an hour, and that works okay. So this issue of being directly beside your greatest population base, and let's call that our downtown core with all of our high-rise condos, from a dense population sector, that doesn't mean that the building needs to be on the lakeshore at Spadina. It doesn't even mean it needs to be in a market like South Etobicoke, other than, Purolator is expanding their footprint in South Etobicoke. So there are those case studies. But all in all, when you look at Amazon, probably the leader of that last touch, most of their facilities are in 905 or on the fringes of 416.
right. And so there just isn't enough demand. Like I was thinking, like if you know, dropped your toothbrush in the toilet and, you know, need a new toothbrush and you got to be rushing off to work, you just, you know, you boop, 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 hit your phone, and 10 minutes later, the drone drops off a new toothbrush at your window. But, you know, clearly it may just be not economically feasible.
We might need that drone.
Cost you $300, right, to get that toothbrush.
When all those bike lanes get removed and all of those bikers can't deliver lunches and stuff.
Let's not go down that road.
Too polarizing of a topic right now to get
seriously.
into it.
Anyway,
Back to
it's
industrial.
my pipe dream. It's my pipe dream.
Yeah. Well, that was quasi-industrial, you know, for the record. Gord, you mentioned February 2022 is the date that everything kind of changed in the finance world when bond yields took off in the wrong direction against us. And, you know, back then you could, you know, probably buy an industrial building at a 5 cap or slightly below, but then interest rates went above that, and people were accustomed to buying industrial buildings with negative leverage, all predicated on the fact that you would see this massive rent growth, so you'd be back on side, you know, shortly after purchase. You know, now we're in an environment where maybe you're not going to see the rent growth, but finance costs have come down. You know, bond yields are down quite a bit in the last year. So what's buyer sentiment in light of, you know, this new bond yield environment?
Well, the industrial investment asset class, shockingly, has been very resilient. A lot of bid depth. There's going to be a marker in our Class A industrial space within the next couple of weeks that's going to price Class A industrial at about a 5.2. That buyer likely will not even use debt. But quite honestly, like we've had portfolios out all year, good quality multi-tenant. Very seldom would we not do a deal somewhere around a 5.5 to 5.75. Rental growth story is not as positive as it was a couple of years ago. So if there's not a rent growth story, and you know your financing today is probably somewhere around 4.75, is that spread sufficient? I don't think it is, but the market is saying it is. So Gord Cook's assessment of what someone should pay today is probably a little more pessimistic than what the market's talking about. I don't know what they know that I don't know, but on average, over the last decade, that spread was 400 bips. Today, we're nowhere near that. So industrial skinny. And maybe that's why our Canadian institutions have been net sellers for the last 2 years.
And there must have been an influx of capital too. I mean, all we've been hearing at conferences for the last number of years is beds and sheds. Everybody wants to get into those assets and get out of the other ones. So as people reallocate their resources, ultimately to just accept, you know, a thinner yield, there's going to be just a limited supply of industrial assets to put your money into, and more capital kind of seeking it.
Well, that transaction volume and those players were our Canadian pension funds in 2020 and 21, and probably a bit of 2022. But in 23 and 24, Canadian pension plans were net sellers of industrial real estate and selling at very good values, maybe just off the peak, but exceptionally good values. What has replaced them on the buy side has been foreign capital and Canadian private investors. So that means sometimes the big portfolio deals is no longer a portfolio premium. You need to actually sell in pieces to attract that private buyer that remains active, kind of 75 million and below. And then we've had some really big foreign capital coming into our market. You know, the family office of Zara, a big player in the industrial business, tracking a large deal right now. Prologis, another big player. And when you look at the Dream GIC structure, you almost put that in a foreign bucket as well. Mm-hmm. Right? Mm-hmm. I think the interest rate story is kind of getting to where it's going to be. I think the story now is around, we got to get our economy going. We got to bring consumer demand back, which then drives consumption. Warehouses are nothing more than a place for consumption goods. And that's how our Canadian markets work. That's how our U.S. markets work. So really today, interest rates might have more help for the Canadian consumer so they can start saving again. I'm a bit of a pessimist on that too, because, you know, CPI is a relative change. Everyone's still dealing with a very high cost of living today. So how much spending are they going to have? And the other story is on rent, right? So the debt story on yields and spreads, I don't know. It really is, what's the outlook on rent? Because right now the outlook on rent is going down. Put that in your Argus model, makes it very hard to buy.
Yeah, no, it makes it tough to justify any investment. Gord, Gord, we are out of time. I'd like to thank our sponsors of the speaker video series, CGI and Doust Vukovic. I'd like to thank First National for powering the podcast. And of course, Gord, really appreciate you taking the time to come on.
Well, glad
Thanks
to be
very
here.
much.
Really enjoyed the conversation. Thanks, guys.